Well, good morning. My name is Ala McCoy. I am Director of Startup Support at the University of Maryland's UM Ventures. And I would like to extend a warm welcome to all of you who joined us today on this beautiful fall morning for the next installment in Startup Fundamentals Workshop Series. Both a live webinar audience and also those watching a recorded version on our Startup PMD YouTube channel. This workshop series is offered by UM Ventures in collaboration with MTech at the Clark School of Engineering and Dingman Center at the Business School here at the University of Maryland. Everyone attending the live session, please feel free to submit questions. You can use the Q&A function at the bottom of your screen. And since we are recording this session, if you would like to remain anonymous, you can do so by selecting Submit Question Anonymously option. We will be posting it on our YouTube channel. Just keep that in mind. So today we will discuss terminology that every entrepreneur needs to know and understand when talking to investors who wish to invest in startup companies, such as angels and venture capitalists. We're not going to do a deep dive in every term and every notion. And the goal for this session is to introduce the term and explain its meaning so that when you hear it, you know what it means and you understand what it means. We will have other sessions throughout the year where we'll be doing a deeper dive in specific topics. And we also have sessions already posted on our Startup UMD YouTube channel that explore some of the topics in depth. So let's get started. So first, we will talk about investment terminology. And when I say investment, I don't mean stock market investment. I mean investment when investors invest in startup companies. So first, let's talk about different types of startups and businesses that there are. Lifestyle business is a company with business model that's difficult or not meant to scale quickly. And it's also not meant to be sold. It's called lifestyle business because somebody is creating this company because they would like to run it as their lifetime commitment. Family-owned restaurants, consulting firms are all examples of a lifestyle business. Lifestyle businesses are not types of companies or businesses that equity investors invest in. And I will talk about why. So organically grown company, it's a business that is financing its growth solely through revenues and then not taking any outside financing, such as equity investments. High growth startup is a newly formed company with highly scalable business model and position to acquire a large market share quickly and to grow revenue to $5+ million within the next 5 to 8 years, of course, depending on the industry. And this is the type of company that's positioned from the very beginning for either acquisition or IPO. So this is the type of companies that equity investors do invest money in. And the reason is when equity investors put money into the company, they put their cash in exchange for a portion or equity of the company. And the way they get paid is by receiving proceeds from sale. So their business model is invest in a company for the next 5 to 8 years, and then hopefully get paid 10x or 15x when the company is sold. And there are two main types of equity investors: angel investors and VCs or venture capitalists. So the main difference is that angel investors are investing on their own personal money. They are investing in high growth startups, again, that are positioned to be sold in exchange for equity in hopes of higher return. Because they invest their own money, they usually invest at an earlier stage than venture capitalists. And they also have a higher tolerance for risk. So they usually are able to tolerate more risk because it's their own money, because typically they invest in industries they understand and know well, and can bring additional value in addition to cash. Venture capitalists are investing other people's money. So typically, a venture capital firm will have a fund. So they go and raise money from LPs or limited partners who put money in. And then a venture capitalist will make investment from that fund. So because they invest other people's money, they have, they usually invest bigger chunks of money and at a later stage, because their risk, they do not, they would like to de-risk the company or technology before they invest it. They also do bring other value other than cash. But the main difference, again, angel investors invest their own money earlier, and VCs invest other people's money at a later stage. So when equity investors invest money, they put the cash in a company in exchange for equity. Equity means it means shares of a company, usually expressed in percentage on term sheet or cap table. Typically, you'll hear such term as equity pool. Typically, an early stage company will set aside a portion of company shares that are reserved for future key hires. For example, if you plan to attract a new CEO, CTO, CFO, because startup companies are short on cash, and cash should be spent more on R&D or business development. Typically, early employees are paid by a combination of cash and equity would come from equity pool. So there are different types of investment stages. You've probably heard that. Pre-seed is the earliest stage. Typically, angel investors do pre-seed investments. Seed is where venture capitalists come in, or institutional investors. And then after that, it's Series A, B, etc., and all the way to mezzanine. And capitalization table is a very important document. It's a table that shows who owns what stock or equity in the company, and also the type of stock that they own and percentage ownership. So it's a really important document that everybody needs to keep from the very beginning in order to understand the ownership, who owns and what type of equity of your company. So this is something when you're talking to investors, one of the first things that they'll ask to see is your cap table. You can keep it in an Excel spreadsheet, or there are companies that offer software as a service where you can keep your table online and give access to your investors. One of such companies is Carter and University of Maryland. We can give you access to Carter account if you're an IP-based startup from the University of Maryland. So let's talk about different funding types as well. Really important notion here. Non-dilutive, there's no dilutive funding and dilutive funding. Non-dilutive funding, it's type of funding that does not require equity in return. So for example, an SBIR grant will provide you with $150,000 to $150,000 in cash, and they're not expecting a portion of your company in return. So any type of grant usually does not expect anything in return other than reporting. Bank loans are also non-dilutive. When you are taking out a loan, you typically are not expected to give a portion of your company to the bank in exchange. Dilutive funding, on the other hand, it's funding that takes equity in return for cash. And thus, the reason it's called dilutive, it's because it's diluting percentage ownership for existing equity holders. So for example, if you have two owners of the company that each own 50% of the company, if an investor comes in and puts cash in a company and takes 25% of the company or 30% of the company, the original investors are now not each owning 50%. So if it's 30, then it's going to be, their ownership is going to be diluted to 30-some%, and so on and so forth. Company stocks are also different. And the most important notions here to understand is, so there is common stock of founder shares. So this is equity held by founders and early employees of the company. This stock gives shareholders voting rights in proportion to the number of shares that they own. And it almost always is fully dilutable. So it's usually the lowest common denomination stock, and again, fully dilutable. When investors come in, a lot of times they'll try to negotiate preferred shares that offer various protections to the owners of such stock. For example, there could be anti-dilution preferences. Their stock might come with liquidation preferences, which means that when the company is liquidated, they would be the first to get paid out of any proceeds. And sometimes, there's a preference that will say they will get paid twice. They will get paid not only first, but they'll also get twice or 3 times the amount that they put in before the common stock investors come in. So really important to understand the type of preferred stock that your investors are asking for. At the very early stage, typically equity investors will not negotiate what portion of the company they will take, because it's really hard to put value on your company when it's so early. And to avoid that, they will invest money through convertible debt note. It's almost always going to be a convertible debt note or a variation such as SAFE at an early stage. What it means that the investor will put in money into that company, and that money, without negotiating what percentage of the company they would be taking in return. However, almost always there are provisions that this money will convert into equity during the next round of financing, depending on what the company will negotiate with that next investor. Usually there is a discount that they will get, and that might also be interest that this convertible debt note also earns. In some cases, it could also be converted to a regular loan as well. And this is usually negotiated with the investor ahead of time on under what conditions it needs to be repaid, or it would convert into equity. A SAFE note has become very popular. It's a variation of a convertible debt note. SAFE stands for Simple Agreement for Future Equity. Unlike convertible debt note that can convert either into equity or into a loan, SAFE can only convert into equity. So there's no loan component or possibility. Investors, or it's easier, it's fairly easy to draw up a SAFE note. However, when you are taking SAFE notes, you have to be careful, making sure that you account for all of them and you understand how many notes do you have that will be converted into equity in the future, because they can add up real quick. So there's a question, how do we know if we are seed or pre-seed? Typically, it depends on the stage of the company and also the amount of money that you're raising. Typically, your first investment, when you're really early on and you need, 100K or something like that, that would typically be considered pre-seed. And then when you are going and raising a higher amount and you're talking to more established angel investors, institutional investors as well, that would be more of a seed round. And we talked a little bit about dilution. Here's an example of dilution. So dilution means that when company issues additional shares to new shareholders, could be investors, it could be new hires. These additional company shares reduce the percentage of a company attributed to each share. And so here's the example I gave earlier. Founder A and founder B each own 50-50. And when an investor comes in and takes equity, 40% of the company, it dilutes the original founder's shares. Doesn't mean that the shares are all of a sudden less valuable in terms of money. Hopefully the money that investor puts in will make the company more valuable. And so that 20% piece would be more valuable than the original 50% piece. That's the idea. If you think about it, owning 1% of Google or Under Armour is much better than owning 50% of a super early stage startup that we don't know if it's going to be successful. So the percentage of the pie doesn't matter because the value usually goes up. It does matter, but the value of that pie, of that piece of the pie, is the more important piece of information. And so we talked a little bit about the anti-dilution provisions that could be included. So that means that anti-dilution provisions are usually applied to preferred shares and do not either fully dilute or not dilute at all with common stock of founder shares. Usually weighted average is used, could be broad-based or narrow-based, but in some cases, some investors will ask for full ratchet. It protects and basically protects those investors from any dilution whatsoever. But that's typically not seen. So when you're talking to investors, hopefully some of you attended the startup showcase that we just held on October 10th. So when you're talking to investors, there are key pieces of communication that they expect that you should prepare before you even talk to investors. So first would be elevator pitch or one-liner. Elevator pitch means it's a 1 to 2 sentences describing what is it that your company does in your value proposition. It's not designed to tell the entire story or to talk about the benefits of what you're offering or explaining how your invention works. It should be super quick and easy, and it's designed to elicit tell me more response. So think about it's designed to pique interest and to make sure that the potential investor is interested in learning more about what you have. Then comes the investor pitch deck. It's usually 10 to 20 PowerPoint presentation, depending on how much time you have and what level of detail you're expected to provide. Usually it's a pitch deck that describes your startup, mainly what is the problem that you're solving, how big this problem is, that will talk about how big your market opportunity is, what is your solution, your secret sauce, who are your competitors, direct and indirect competitors, what is your business model, and how do you plan to take your product or service to market, what are your financial projections, and most importantly, your team. Talk about your team and why is it that your team that will make this company successful. And then comes executive summary. There are two types of executive summaries. You should have a 1 or 2 pager. It's a short executive summary, briefly describing everything above, and having a very brief financial projections. And then there should be a more detailed executive summary as well prepared, usually 3 to 15 pages. Used to be called business plan. We don't call that anymore. Business plan, it's now called executive summary. And it provides more details about the business model, financials, and your go-to-market strategy. So all of those documents should be prepared, and you should have a data room prepared before you talk to investors. So all of that needs to go into a data room. It's an online digital storage space where startups store documents for investor due diligence. So once you pique investor interest and they are interested, you should be ready to give them access to your data room so they can dig deeper into your company and learn more about your company's financials. They could review your pitch. So just to be clear, it's not just the documents I just mentioned that would need to go into a data room. They would also expect to have accounting, financial documents, legal documents, everything about how your company is incorporated. Cap table needs to be in there. Incorporation documents, operating agreements, anything that pertains to your company needs to be ready and included in the data room before you even talk to investors. And there's a question. Can you talk about the ways companies value shares for a cap table, especially early on in pre-revenue? So typically companies don't put value on the shares, especially early on. You typically put in percentage owned. And when investors come in and invest money into your company for specific percentage, that's when the value is put onto your company. And so, for example, take easy math. An investor comes in and says, here's $1 million for 25% of your company. That means they just put a price tag on your company at $4 million post money. And that's how the company's or the stock gets priced. How they calculate it, it's a different story. They use several methods to calculate the value. And we'll have a separate session on that. But basically, that's how the value of the company gets calculated. And like I said earlier, typically investors try to avoid putting the value of that company, so they won't come and say, here's $1 million for 25% of the company. They'll say, here's 100K as a convertible debt note, because we just don't know what value, especially when it's really early. So they'll do a convertible debt note, and when your company a little bit further along and there's more clarity as to what the value of the company is, that's when they'll negotiate specific percentage in exchange for specific cash amount. And then there's a question about what's a good service to use for data room. It has to be something secure. Google Drive. I don't know if Google Drive provides enough security because you will be putting a lot of sensitive data. There are some companies that provide that service, or Dropbox offers more security than Google Drive, for example. So I would research in terms of, where either there are some companies that provide you with an option to store your cap table, and also offer secure data rooms, or you can do Dropbox or something else. But make sure it's fully protected. So other things, really important ones that need to be in your data room are the 3 most important financial statements. These would come from your accountant, and they're called income statement, statement of cash flow. And we will talk about each one of them. So in financial projections. So let's start with income statement. This is a document that typically your accountant prepares, or if you're using QuickBooks or other accounting software, you can generate it. It's a financial report that summarizes a company's revenues, expenses, and profits or losses over a specific period of time. And it's typically divided into income and expenses. So money in and money out. Typically early on, startup company doesn't have sales. And so you would have, different ways of money in, but it's really important to understand what goes in what portion of the income statement. Again, either an accountant or accounting software will help you figure that out. So income statement. So this is a table called EBITDA, which stands for earnings before interest, depreciation, tax, and amortization. This table typically would go on your pitch and also in your short executive summary. Usually, depending on the industry, investors would want to see between 5 and 7 year EBITDA table. And the reason this table is really important, it's an easy way to show earnings or projected earnings of a company, regardless of its capital structure. So it really shows what the actual business model is able to produce. Very simple, revenues minus expenses, and what would be your earnings before interest, depreciation, tax, and amortization. And this is what investors are usually looking at. It could be either a table, could also be expressed as that hockey stick projection, but typically a table like this, and if you can show number of potential customers, that could also be valuable because it just adds that additional detail. So the EBITDA table is really important. So in your income statement, usually it's really important to understand when investors will ask you, what are your variable costs, what are your fixed costs, and what are your cost of goods sold. So this is something that you should know from the back of your hand and be able to answer questions. So variable costs are costs that change with the amount of products or services provided. So for example, you need to buy more materials, or you need to pay more for hourly labor with every unit of product that you produce. Those are called variable costs. Fixed costs or overhead costs that stay the same regardless of the amount of products or services produced. So for example, rent, any type of capital investment, equipment, full-time salaries remain the same. And so understanding what each variable or fixed costs are important, and investors will expect that. And also COGS, or cost of goods sold, is another important notion. It means variable costs plus variable labor attributed to products sold. Each industry has its own expected standard for COGS. So for example, in the restaurant, the food industry, 30% COGS would be expected on food, and each industry has their own standards. So it would be important for you to understand what COGS standards are for your industry, just to make sure that you fall within that number. Operating income, revenues minus COGS, minus full-time employee wages, and minus depreciation and amortization. And this is an important number that shows really what is, what the business model is able to produce, regardless whether or not company has loan or any other debts to pay. So profit margin, revenue minus COGS. Again, each industry has its own standard profit margins that are expected. So it's important for you to understand what profit margin is for your industry and fall within that number. And another really important notion that's not necessarily included in any financial statements, not necessarily expected in your data room, but I thought I'd throw it in here. It's sunk cost. It's investment or cost that cannot be recovered. And very important is, but really hard to do, is sunk costs should not be considered in making decisions about future strategy. And it's sometimes really, really hard to do. If you've just invested money in this piece of equipment or in this subscription or something else, and you feel like you have to use it, but sometimes, sometimes it can get in the way of your future growth and future strategy. So balance sheet is another important financial statement that your investors will expect to see. It's a financial statement that summarizes a company's assets, liabilities, and owner's equity. Again, this is something that either your accountant will produce or your accountant software will produce for you. It should always, so your assets should always be equal to liabilities and shareholder owners' equity. And it shows basically where the company is in terms of assets, liabilities, and what share and what the owners own. And another really important, especially for startup companies, a cash flow statement or statement of cash flows. It basically shows cash in and cash out. Companies usually go out of business because main reason is because they run out of cash. So understanding what your cash flow looks like, how much money you spend per month, how much money do you have left, how much money do you need, this is all about cash. So cash is king. So understanding statement of cash flow is another important financial statement that your investors and you as an entrepreneur should really pay attention to. Okay, so we have some questions. So for data room, question is, should we be concerned about sensitive legal IP data? Do we give investors view into everything? So typically you would start talking to investors with non-confidential data, such as maybe your pitch deck and such. Usually when they are ready to do deep dive, you should sign and you should have a non-disclosure agreement signed with investors, which they won't sign just to talk to you or just to hear out your pitch. But once they are ready to do a deep dive and look under the hood, they will. So you shouldn't be sharing sensitive legal and IP data until you have that confidentiality NDA in place with investors or anybody else who's looking into your company. I hope that helps. And yes, you will get it. I can provide a copy of my slides. Keep those questions coming. So other things that you might hear, terms you might hear about money out and money in. So money out, burn rate. It's a very specific startup term, basically because all startups at the beginning are losing money, and when you're pitching investors, you typically are not expected to have revenues quite yet, or not expected to have to be profitable quite yet. Burn rate basically means how much money is your startup burning through every month. So what is that cash amount that you are I don't want to say losing, but you're using up every month to grow your company? That's called burn rate. Cash runway, how long will your current funding last? So you're burning through $1,000 a month. You have 10,000, so your cash runway is 10 months in simple math terms. And run rate, forward-looking projection of financial performance based on current startup needs. But basically, you need to understand how much money will you need going forward based on your current needs. That was money out. Money in, revenues or sales, stands for number of products or services sold times actual price charged. So this isn't profit, this is just revenues or sales, basically how much money is coming in when you're selling products. Revenue streams, sources of revenue for your company. And each company may have several revenue streams. So for example, you could have revenue streams from selling hardware, and then additional revenue stream from selling consulting services or servicing of that hardware. So you might have different revenue streams. So understanding how much money would be coming in from each is important. And then of course, profit, financial gain after expenses are subtracted from revenues. So net profit is the bottom line. So you take your revenue and sales and you deduct everything, all of your expenses, variable, fixed, would come out, and then what is the actual bottom line? That is your profit or net profit. So that's all I had. I know it was a lot, like I mentioned. This is not meant to do a deep dive into every topic, but we'll have additional topics, additional workshops. Pardon me, by accounting professionals, by investors, attorneys, to help you better understand, sorry, each of the topics that we covered today. So additional training is already available on our Startup UMD YouTube channel. You can take a look and see what sessions are there. And more sessions coming up, live sessions, please sign up. Also, University of Maryland I-Corps is a great training for any early stage entrepreneur or anybody who's thinking, taking their invention, innovation, and that idea to market. Highly recommend. That is all I have. If you have any additional questions, please submit them. So I have a few questions here. The first one is, who do we reach out to for an example NDA at the pre-seed seed level? Ideally, an attorney. There are some online services that can provide a template as well if you don't want to pay an attorney quite yet. But it's NDA is a document that an attorney or legal professional would draft. You can probably find free templates online, but you know, it's something that you should consider talking to an attorney about. Question? Oh, I already answered that question. Any other questions? And thank you so much to everybody who came and stayed to the end. Thank you for great questions. I will share my slides. If you shoot me an email, tell me that you want them. And this session will be posted on our Startup UMD YouTube channel, so you can rewatch it again there if you wish to do so. Also, feel free to shoot me an email. Happy to connect with you and answer additional questions. Also, if you have any suggestions for any future topics, please send them my way, and we'll do our best to find a speaker to discuss any topics of interest. All right, well, don't see any more questions. So thank you so much. If you think of one later, please send me an email or give me a call. Thank you, everyone. Have a great day.